Welcome to our YouTube video series on business law. My name is Christopher Neufeld of Neufeld Legal, and in this particular video we'll be discussing the concept of a tax-free rollover. Now, to understand how rollovers work, we have to go back to general rules of taxation of capital gains and losses, in that all dispositions of capital property result in an immediate recognition of a capital gain or loss. And this rule also applies to non-arm's length dispositions under Section 69 of the Income Tax Act. However, in some circumstances, particularly in non-arm's length transactions, there is often no real change in the economic interest in the property, such as an example where an individual transfers property to a wholly owned corporation. There is no real change in the individual's economic interest in the property. Thus, a rollover may provide, in limited circumstances, a deferral of capital gains or losses. That means a delay in the timing aspect, as well as other types of income. A rollover normally provides for a transfer of property at a value that will be referred to as the tax value. Now, this is a term that's not used in the Income Tax Act, but is meant to refer to the adjusted cost base, undepreciated capital cost, or other tax value representing cost. In return for the property transferred, the transferor should receive a package of consideration, being the total fair market value of which should be equal to the fair market value of the property transferred. Thus, this fair market value exchange is done to avoid important tax complications, and on the ultimate disposition of the property by the recipient or the transferee, the gain or loss that was deferred at the time of the original transfer, the rollover, is included in the transferee's income. So, the basic concept and the basic provision in the Income Tax Act is Section 85. And Section 85 permits a tax-free rollover of property to a corporation, but only as long as a transferor accepts shares as part of the consideration for the transfer. Thus, the basic concept is that the transferor, who is now a shareholder of the transferee corporation, should be in the same economic position that they were in before the transfer. Therefore, the adjusted cost base of the shares that they receive should be exactly equal to the adjusted cost base of the asset transfer. Now, the deferred income inclusion, hence capital gain, will be triggered if the shares are sold in an arm's length transaction. Similarly, the corporation would retain the adjusted cost base of the transferred property. This is the basic concept behind a pure tax-free rollover. Nonetheless, there are going to be additional variables which will add to the complexity of this concept. And it is those variables that need to be addressed, all the more importantly, to assure, one, that they're getting the appropriate tax treatment and minimization of taxes. For first, the transfer is permitted to trigger income inclusions, for example, capital gains recapture, if they so desire. And secondly, the consideration can be not only shares, whether common and preferred, but also debt or cash. Using these variables, you can optimize your situation, but it creates added complexity and hence the need for appropriate professional input from lawyers and accountants. And that is the general concept behind a tax-free rollover and the utilization of Section 85 of the Canadian Income Tax Act.